Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about commercial real estate and kind of the state of where it is here in the United States, as well as some of the information that I track in my work as a banking and community financial institution consultant. This is via request from the Discord chat, which is linked down below in the description, and I would highlight that this is going to be more of a podcast style where I'm going to walk through some of the data that I look at on a weekly basis and some of this information as it becomes available. And we're just going to walk through this information. You should be able to follow along via just listening. However, I am going to be sharing some information on the screens as well as where I'm pulling that information in the first place. The first thing that I would note is what I'm sharing on the screen comes from the CBRE. This is a commercial real estate group. They do an annual survey from their lenders and who they work with, where it showcases kind of market sentiment and where things are going. And the primary item from this one is a report that they provide that came out on March 7th, and it is on U.S. cap rate surveys for the second half of 2022. The 2023 report should be available sometime later this year for the first half of the year. The first thing that I would note in this document is when we're reviewing the information, you can see that the average cap rate, and this is all types of properties, they have some breakouts down below, is about 6.14%, and that is coming up from the lows of the 5.41%. Now, it's important to note that when we're talking about commercial real estate, there is a significant amount of news articles, there's a lot of wear and tear, there's a lot of concerns around the commercial real estate sector. That is one of the largest lending sectors. It is definitely heavily weighted towards a number of community financial institutions. These are going to be banks and in some cases even credit unions, but mostly banks under 50 billion in total assets, especially if you get into the smaller community banks where you're talking your banks that have anywhere between 1 to 10 branches and they really serve your local community. They are going to heavily invest in 1 to 4 family loans. They're going to heavily invest in commercial real estate, commercial mortgages, and they are going to invest in commercial and industrial in some markets, so C&I type of lending. What I'm showcasing here, this real estate cap rates, when we're talking about cap rates, or also known as capitalization rates, that is a particular metric that commercial real estate investors utilize to determine is it an appropriate return on investment. Or the follow-up to that is this is what a credit analyst at a financial institution would leverage to determine are they going to be able to pay off their loans. So this is something that I would highlight. They are going to calculate by taking the NOI, or the net operating income. So this is essentially how much money the business or the property is bringing in versus how much it's actually worth. So the example that I would call out is if you have a property that's worth $100,000 and its gross rents are $6,000 a year, and it is bringing in that $6,000, then that means that their cap rate would be 6%. So the reason I'm highlighting all of this is you can see that during this time period, so you can see here for the first half of the year, for Q2 of 2022, that we are going to be bringing in a cap rate of 5.41%. Whereas now the cap rate as of the end of Q2, or rather Q4 of 2022, was 6.14%. The reason that I highlight this is because last year, beginning in last year up till now, we've seen one of the largest as well as the quickest increases in interest rates over really any historical time frame. Even from 2004 all the way to 2007, this time frame was a lot slower. But we have seen a rapid rise in interest rates that is going to directly correspond to increases in debt service payments. So when we talk about debt service and debt service coverage ratios, this is the amount of money that a borrower is going to be required to pay their debt. So the higher the ratio, the better, or rather the more strength that a borrower has. So for that $100,000 property that I mentioned earlier, if they have a total mortgage of $10,000 a year and they're only bringing in $6,000, then they are not going to be able to cover that mortgage payment. Whereas if they were bringing in $10,000 and their annual mortgage payments were $10,000, they would have a 1-to-1 debt service coverage ratio. So what tends to happen is as interest rates increase, you begin to squeeze out borrowers out of the market. They're going to be similar to 1 to 4 family, where you're looking to buy a home. There are going to be a lot of borrowers when interest rates are at 2 and 3%, which is what we saw in the 1 to 4 family side, or the residential mortgage, or even commercial mortgages. So, and I would highlight that to showcase the interest rate increases, I'm utilizing the federal funds effective rate, and this is going to be the rate that the Federal Reserve and the banks are going to get when they lend money to the Federal Reserve or when they keep money there. So when it was at essentially 0% here, what we were seeing is that when the banks would lend that money out, you were able to get commercial mortgages for under 5%, under 6%, and you were able to get residential mortgages for anywhere between 2 to 3%. And as we've seen for the 1 to 4 family side, you begin to squeeze out buyers when you increase interest rates. The average interest rate on a mortgage right now is sitting around or just north of 7.2%. There are going to be a lot of buyers that were willing to buy on this side of the curve when that interest rate was 2 and 3% versus the ones who are going to buy north of 7%. And the same can be said in the commercial real estate space. Now, this was compounded by the fact that we had a significant number of institutional buyers, or rather a significant number of businesses that had these large corporate offices that has a large percentage of the workforce is now going remote. So not only are we seeing buyers get squeezed out over here, but we are also seeing the people who would want to buy, who have the larger corporate spaces, they are downsizing, which is opening up quite a bit of supply. Now, the U.S. cap rate survey that we've got here, they produce a significant number of reports that are market specific. You can find that information on this website under the Insights and Research. There's a significant amount of money in there, so there is some cool info available there. I would highly, highly recommend. They do a great job. They do a lot of free research. There's also a number of paid reports. So I would highlight that there is a lot of great information in there. The reason that I highlight all of this is because we've got interest rates going up. We've got borrowers being squeezed out. You've got businesses that are opening up supply. And to compound all of this, due to the fact that we have this narrative that CRE is worrisome, you're going to begin to see a tightening of lending standards, which means that banks and credit unions and other alt lenders who were willing to give you money when these interest rates were lower because your debt service was going to be nice and low, are going to begin to say, hey, we actually want to have a much higher debt service. We expect you to make these payments comfortably, not just from the business, but also out of your personal pocket in the event that the business is struggling. Conversely, they expect you to put more money down. Another key component of lending is going to be the loan to value side, which means that they want the value of the property to be much higher than the value of the loan. And that makes sense when you're lending money, but now instead of a 75% LTV, they may say that they want you to have a 65% LTV. So the difference on that $100,000 property I mentioned earlier is instead of putting $25,000 down, you're going to have to put $35,000 down, which is a nearly 30% increase over that $25,000 number. So at the same time we're seeing tightening lending standards, that means there are going to be less people willing to lend, increasing supply, as well as decreasing capabilities to make money on these investments. So the average CRE loan can be assumed to be somewhere between 6 and 8% at this point in time, or rather 6 and 10%, and probably can be settling around that 8 to 9% area. Where that means that the cap rate here, again, this is going to be on a little bit of a lag, but at this point in time, those cap rates are at 6.14%. What that means is that the average cap rate, or the cost to service debt of 8 to 9%, is higher than the average cap rate that we saw at the end of last year of 6.14%. And we're seeing that at the same time that supply is coming onto the market, as well as buyers are walking away from the market. So this is going to be our concern when we talk about commercial real estate prices. Now, we already began to see some of that contraction at the end of last year. This is the prices for CRE year over year, where we saw that drop by about 1.7% Q4 over Q4. It's important to note and to watch this information on a go-forward basis, because when this drops, I would expect that you're going to then see across the board, it'll be noticeable that will see commercial real estate prices drop in our individual markets. Now, while you can use the CBRE to track some of that information, I also highlight another free great resource is going to be the Atlanta Federal Reserve Bank. And they showcase a significant amount of data on a market-by-market basis that is going to be available here. So you can actually view quite a bit of that information. And you can see things like rent growth, vacancy rates across different properties. And you can see that those strip centers, that vacancy rate is trending downward. And the information in here contains quite a bit. So one of the things that I would highlight if you're reviewing or evaluating some of this information is when we're looking at these individual markets and walking through some of the different areas, you do have the capability to see, well, what's happening in Abilene, Texas. And some of these areas, again, we can look at our bell curve, you can see that some markets are doing very, very well in terms of their trends, and some are going to begin cooling off. And we can actually break this out on property type basis. One of the charts I would showcase is that even though we began to see a slight decline in vacancy rates, so just to showcase this information, vacancy rates are increasing, especially in the 10 to 20% range, but even in some of these higher categories, this is on a market by market basis. We are seeing vacancy rates at north of 30% on malls, strip centers, and some of the other additional metrics that are available here. The reason that I highlight this out is we've got vacancy rates increasing, we've got prices dropping, and I would highlight that when we talk about is there going to be a buyer, there is always going to be a buyer for these properties, but what the market is telling us right now is that the current value of these properties is not equal to the value that the buyers are going to showcase, especially at current debt levels. So the question is going to be not if, but when we're going to begin seeing an unwinding in commercial real estate, and in particular, what industries. Again, I think some of the highlighted ones of office is going to continue to be a key driver, but there are even things like long-term care facilities, hospitals that have overbuilt in preparation for or in the fallout from things such as COVID. Or you can also see in some of these situations the fallout or the follow through of things like warehouse, where you had companies like Amazon that were expected to continue to build, and they ended up not doing so. So what I'm expecting on a go-forward basis is that our current charge-off rate associated with business lending is going to normalize. Now, if we were to look at a long-term average, especially from one over the past 10 years, we're probably going to be closer to 50 basis points or 0.5%. Right now, we're currently sitting at 0.28 or 28 basis points, 0.28%, which is more than double where we were in Q4 of 2021. So this is increasing. The question is, are we going to normalize to where we were in 2019? Or are we going to see this pop into another recessionary time frame where we do see losses up north of 2 and 2.5% on commercial loans? Now, the Federal Reserve, as part of their annual DFAST results, the stress testing for community banks, they showcased that there were more than $350 billion of commercial real estate charge-offs. Now, any percentage of that is going to be still very high compared to the results today. And the question is going to be that, do those properties get bought up? Do they get turned into something else? What's going to happen? So those are going to be some of the things that we'll be actively watching and or evaluating on a go-forward basis. And what I've walked through here are just a few free resources as far as how I'm tracking commercial real estate on a go-forward basis. So let me know in the comment section down below what additional thoughts, questions, feedback you'd like me to opine on, or anything that you have to add value here, and what do you think is going to happen. If you made it this far, I want to let you know I appreciate you, and tune in next time for as we go through some macroeconomic stuff. Thanks. Talk to you later.